author, columnist, managing editor of LibertyNation.com, podcast host and conservative policy advocate.
We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
Just how much more shock can the American economy withstand before folks decide to just call it a day? As a prominent Californian bank shutters its doors, the White House scrambles to avoid a wider market contagion. But does the president instill confidence? Well, that's the $25 billion question. Welcome to Liberty Nation Radio here on the Radio American Network. I'm your host, Mark Angelides. On today's show, we talk the potential dangers of a banking collapse, the solutions on offer, and take a look at the latest gun control laws coming down the pipeline. I'd like to take a moment to wish a fond hello to our listeners out in Chester Springs, Philadelphia on WFYL 1180 AM. Thanks for being here. Remember, this show is proudly sponsored by LibertyNation.com, where you can access podcasts, breaking news, analysis, and a range of biting and brilliant shows to whet your appetite for freedom and your fondness for the great American Constitution. With the collapse of Silicon Valley Bank, tongues are a-wagging about whether this was merely a first domino in a crisis set to consume the industry, or just a blip in the economic dystopia America is facing. Now, the best reporting on this topic is on the pages of LibertyNation.com, written by Liberty Nation's economics editor and host of the excellent Swamponomics show, which I recommend you all tune into, Mr. Andrew Moran, who joins us here today. Thanks for being on, Andrew.
Thank you, Mark. And I will say that all the deposits are in Mark's house and Laura's house. That's my James.
Thanks very much. It's a wonderful life. Now, Andrew, let's get the basics down on this first. Sure. What caused Silicon Valley Bank, SVB, to fold?
Well, she can write a whole thesis on what transpires. I'll try to summarize it best. So the first thing is that when Silicon Valley Bank started and had these exorbitant amount of deposit rate to attract, tech startups, tech executives, a lot of that Silicon Valley community, in order to offer those exorbitant rates, which are so much higher than a lot of the other larger banks offered, they bought long-term bonds to offset that risk. The problem with them when they started buying these long-term bonds is that when the Fed started raising interest rates, the value of those bonds started crashing. So if you look at LibertyNation.com, we reported on, which a lot of people did, Liberty Nation reported on the collapse of the bond market. So their balance sheet were completely decimated by this. And the other issue with Silicon Valley Bank is that they lended a lot of money to some of their depositors who are really risky venture capitalists, venture firms. So when you have those two issues mixed with a collapsing bond market, which completely erased their valuations, that's when you had that problem with Silicon Valley Bank collapsing.
So you wrote an article recently, one of many on this topic, describing how this particular bank was marked as a safe bet by auditors. And where's the responsibility here, Andrew? Why can these audit outfits get away with, like, literally a few weeks hindsight, be considered sloppy analysis?
Well, the organization that was in charge of the auditing firm, they said that they monitored the 2022 books for SVB. They said that they didn't see any problems, and that anything happened after that period, it wasn't their responsibility. But my contention is that couldn't you? Because the whole point of audit is to identify potential risks at a financial institution. This thing didn't spring up overnight. It didn't happen after Greg Brecker sold $3 million of his shares. This thing started going on probably last spring when the Fed started raising interest rates. So that was sloppy reporting. Now, I will defend the company that did the audit. They also gave high marks to Signature Bank. Now, Signature Bank didn't see any. According to the board of directors anyway, they didn't see any financial problems. The problem with
Signature Bank was the second bank that had issues in these last weeks.
Yeah, well, actually, it was a third bank. The other one was Silvergate. But Signature Bank, the according to board of directors, one of them was Barney Frank, who was a congressman. He was the chief of the Dodd-Frank bill. He said that their books were fine. The problem was that it was a contagion event where depositors were spooked by what happened to Silicon Valley Bank, and then they withdrew $10 billion in one day. And that's when the federal regulators saw a problem, and then they shut it down and they sent a message saying, you got to be careful with these issues. You got to have greater capital. So that's what happened with
that really brings up a question that I think has been completely ignored. Maybe not a question as such, but more a position. You say that depositors took out tens of billions of dollars, and yet $10 billion. when well, that is 1/10 of billions. Learn set theory. So you have Joe Biden, and we'll talk about the solutions that are being proffered later in the show.
Sure.
But you had Joe Biden give a speech about how, you've got basically your mom and pop businesses that will be able to pay their workers and keep their lights on. That's not Silicon Valley Bank depositors by and large, is it? Is it
No.
90% of its depositors are looking for investment vehicles? They're not people, let's use this high street bank or retail banks, I guess we call them in my country, to just manage their current account or their checking account. These are people looking to make money with things. This is not, as Joe Biden intimated, just regular working folk dealing with their daily banking.
Yeah, exactly. And that's the thing with Silicon Valley Bank is that 90% of the depositors had amounts that exceeded the deposit insurance limit of $250,000. So these weren't
$250,000.
just,
Quarter of a million. Yeah.
yeah, $250,000 the limit, which is the deposit insurance. That's how much you're insured for. So 9%. So if 9% of their clients have exceed that amount, it's safe to say that it's not just your 80-year-old grandmother sitting there on her pension fund. It's not the case. These are wealthy people. These are well connected, and I agree with a lot of Republicans who say that it's just Joe Biden and the federal government bailing out their buddies in Silicon Valley who lean heavily left. So yeah, I agree with that supposition.
So let's dig into this. And so we had the analysis, the audit analysis, and it failed to recognize things that you say, or well, the data, I guess, suggests that these things were happening last spring. But is this a one-off? Do we think is this one blip in an otherwise stable banking industry, or is there a deeper trend that with that? Let's not go to what's the word, Chicken Little on this thing. But is it a deeper trend that people should be watching? Perhaps audits being too optimistic, that kind of stuff.
Well, it depends on a wide variety of factors. I'm sure right now a lot of analysts are combing through the balance sheet of a lot of these banks. So one of the big issues with a lot of these banks, whether it's the regional banks or the major banks like Wells Fargo or Charles Schwab, is their list of unrealized losses. So if these unrealized losses are continuing to expand on their balance sheet, you're going to have issues with that financial institution, no doubt about it. On the other hand, if these major banks come into trouble, as we've seen with SVB and Signature, the Federal Reserve and the federal government are going to inevitably intervene. That's what they're doing right now. I mean, the Federal Reserve, so part of their plan is extending loans of up to 1 year to banks that were, or saving institutions or credit unions that were impacted by SVB. Now, they're going to extend this to pretty much everybody right now. They have that the 1 year facility, and then you have the Federal Deposit Insurance Corporation offering bailouts to people who are uninsured bailouts to depositors, and then you have the Treasury Department offering up to $25 billion as a backstop. But it's not going to stop there. If you do have a contagion effect, a domino effect of these banks, it's going to be QE infinity. And consider this for a moment. The FDIC has about $125 billion in reserves. SVB had $150 billion in uninsured deposits. Where's that extra money going to come from? It's not going to come from, these wealthy depositors. It's going to come from, guess what? The Federal Reserve unleashing QE infinity and having unlimited deposit insurance. It's not going to be the $250,000 limit anymore. It's going to be probably, as some have suggested, $600,000, and as some have even suggested, having guaranteed all bank deposits, which of course is a can of worms that's going to lead to inflationary mess and moral hazard, if I may say.
There is another aspect to this, and that is that Silicon Valley Bank had its issues because it's Silicon Valley Bank. And if we look at, this is a bank, a banking vehicle that is set up to cater to tech companies, startups, places around the area who deal with Silicon Valley. Mm-hmm. What we've seen over the last, I guess, year and a half is companies like Meta, or Facebook, I guess we know it best as, laying off tens of thousands of workers, losing Mark Zuckerberg losing billions of dollars. Now, is it specific to the industry, do you think, that caused for example, the unrealized gains unrealized losses that you talked about to sort of come to fruition?
Yes, I've spoken to some economists over the recent days, and some of them have made the case that these are just specialized instances whereby, in the SUV's case, it had direct ties to the tech industry, which has been slaughtered since the Federal Reserve raised interest rates. And then you can make the case that, this whole thing started because of that period of extremely loose monetary policy. That's perhaps another conversation for another day. Silvergate, it crashed because of the crash in the crypto markets. It was completely entirely focused on crypto. And even Signature Bank also was a crypto lender. So it had direct ties also to Bitcoin, Ethereum, and that market has been slaughtered too. So I could see the case whereby they say, okay, yeah, these are just, isolated incidents. Maybe there's not going to be a large liquidity issue. But perhaps lead to a broader conversation. The problem you have is that this ties into the Federal Reserve's M2 money supply, which has actually contracted 2 straight months for the first time on record. So it's such a coincidence whereby you have a liquidity evaporating from the system, and then you have these banks having financial troubles. So I think that's an interesting tie-in.
As James Bond author Ian Fleming wrote, once is happenstance, twice is coincidence, third time is enemy action. Now, we're talking with Andrew Moran on the SVB collapse and what it means for America and the wider industry. And we'll be back with Andrew after this short break to continue the analysis. Don't go anywhere. We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
And we're back with Andrew Moran, economics editor, discussing the collapse of Silicon Valley Bank. Earlier in the show, we talked about the industry trends and how SVB may have been a victim of its own industry. But now I want to dive into the solutions being offered. And now, Andrew, you and I, we are both fans of films made more than 50 years ago. And the first thing that kind of popped into my head when I heard about the Silicon Valley Bank issues was It's a Wonderful Life, and how George Bailey, played by Jimmy Stewart, and how he has a bank where there are depositors rushing to get their money out. Now, is it that kind of situation?
Okay, so before I dive into that, I would like to say first that I wrote an article I think it was last Christmas or Christmas before, using that film as a critique on the fractional reserve lending system. Fractional reserve lending system is is one of the factors why you have these banking issues in the first place. Because when you deposit your money, the money just doesn't sit there. The money gets loaned out of Bill's house and Julie's house, and then that's James Stewart's summary of what fractional reserve lending really is. Now, is this a broader issue of people withdrawing their money? Yeah, that's what happened in recent days. A lot of people went to First Republic Bank. A lot of people went to Silicon Valley Bank. A lot of people took the money, of course, $10 billion from Signature Bank. So you do have runs on the banks happening. Now, is it going to happen on a wider scale? I'm sure a lot of these big financial institutions are going to limit the withdrawals. They'll employ similar methods. There is a widespread bank run, which I don't think is going to happen at this point. But overall, I mean, yeah, that was the film summarized what's going on.
So who's Mr. Potter in this scenario?
Also, one thing too about Mr. Potter is that I don't really view him as a villain. I think what's wrong with that Pottersville that's Jimmy Stewart envisioned, with the strip clubs and the gambling halls.
You can actually, believe this or not, read Andrew Moran's defense of Mr. Potter in It's a Wonderful Life on the pages of libertynation.com. True facts, true story, no joking. So,
but if you want to find a villain in this whole thing, I have to once again refer back to the Federal Reserve and perhaps even the federal government. The Federal Reserve's season of easy money era led to this issue. All this money was injected, all this freshly created liquidity was injected into the system. It benefited primarily the financial sector and the tech sector in those 2 years. The other issue is, and of course, those extremely low interest rates that also benefited a lot of people. The other issue is the federal government. A lot of economists I've spoken to, the new talking point is that it's all Trump's fault because he rolled back some regulations out of the Dodd-Frank bill, including raising the threshold for the whole too big to fail stress tests. But aside from that, the whole sector is completely over-regulated. So when you have an over-regulated system, financial institutions are going to take on more risk, and they're going to use client deposits because of fractional reserve lending to employ those risks. And then, of course, they try to offset those risks by taking on secure instruments. But when those secure instruments are crashing, as we've seen over the last year, then you have this whole problem, festering, and it's going to, lead to perhaps a wider issue. And then also one more thing before you go on. when the Federal Reserve and the federal government bail out, whether it's depositors or management or investors, you have something called a moral hazard. In economics, a moral hazard is when a party takes on risk and it's not incentivized to reduce that risk because they're not going to take responsibility or account for the full cost of that risk. So if you have the federal government saying, or the Federal Reserve saying, oh yeah, we'll just give you $10 billion, and you'll have access to all this lending facility because of your bad mistakes or because depositors didn't do their due diligence, then the whole thing is just going to completely continue. And then, of course, in the size and scope of the current financial system, which is $22 trillion, if you have more of this happening, then you're going to have an inflationary crisis occurring.
So you're saying that the moral hazard comes about because essentially in a competitive market, certain banks are being incentivized to take higher risk strategies because they know that daddy's Federal Reserve credit card is waiting.
Yeah, exactly. Yeah, exactly. That was one of the bigger problems during the 2008 financial crisis. You had a lot of these big banks were just bailed out by taxpayers this time. But you could also make the case that even this bailout too could be some sort of taxpayer fund as well, because you have higher.
Well, let's talk about that, Andrew. Now, Joe Biden's put together, and a lot of media outlets have been saying that Joe Biden's whirlwind 72 hours to save the banking system, and it's a great narrative. I'm not sure entirely how true it actually is, but he proposed a series of measures that would draw on certain funds and what. Now, what I'd like to do, Andrew, if I may be so bold to ask, is to explain this to me as if I were a rather slow-witted 5-year-old.
Wait, is that a reference to my son? I take
no, not at all. For those who don't know, Andrew Moran actually speaks to his son exactly the same way he speaks to us, the audience. I'm not saying his son understands it, but he does speak that very way to him. So explain it to me, how this is going to save depositors without disrupting the industry.
Well, okay, so it was a three-pronged approach. So the first one was, as I said earlier, the FDIC, they're insuring deposits that even exceeded the $250,000 at the SVB, which is dangerous because, as I noted earlier, the SVB has $150 billion in reserves and or losses, and the FDIC only has $125 billion in their reserves. So that's one issue they're doing. The other issue is that the Federal Reserve is lending up to it has an unlimited fund, as apparently it's according to what I've seen. Up to 1 year lending facility to banks, savings associations, credit unions that were impacted by the SVB failure. Okay, so and then one more thing.
Wait. So that means that the banks that need to pay the depositors to prevent a complete run, they can take money and as a loan, a structured loan for a year to pay out the depositors. And that will prevent the bank. Right. Good.
And then the Treasury, as a backstop measure, they're going to offer $25 billion just in case the Federal Reserve has losses with these loans. Now, from what a couple of sources I've spoken to, they say that that's not that money's going to be unnecessary. It's not going to be needed because, of course, the Federal Reserve has access to a printing press. What's $25 billion the Treasury Department going to do at this moment? So that's the three-pronged approach summary of of how they're building out the money.
It's the Hillary Clinton defense. At this point, what does it even matter? And we'll be back with Andrew after this short break talking the runaway inflation train. Don't go anywhere.
We dismiss history at our peril. Liberty Nation Radio with Mark Angelides.
And we're back with Liberty Nation's economics editor, Mr. Andrew Moran. Earlier in the show, we were talking Silicon Valley Bank, the fallout, and the solutions. But now, Andrew, I want to turn to inflation. We had the CPI figures out this last week. What were the cliff notes on that, please?
So the annual inflation rate was 6%. This was down from 6.4%. Core inflation was roughly flat at 5.4% year over year. The key components of the inflation report, as I noted in my article on LibertyNation.com, the food supermarket price was still above 10%. Eggs actually noticed a decrease, actually fell to 55% year over year, as opposed to, I think it was above 70% in the last report.
But Americans are bracing for the 2 new egg omelet once again.
But the main issue, and this is what the Federal Reserve keeps monitoring, is that services inflation is still elevated. It didn't change; it was still flat at 7.6%. But 7.6%, that's a huge inflation rate for the service sector. And then you have the next issue whereby if the U.S. averts a recession and the consumer is still well capitalized, which at this point who knows that's even true anymore, then you're going to have a cycle whereby inflation is going to be elevated back in the goods buying sector, as you saw at the beginning of the inflation crisis. So overall, sort of services inflation is the point that everyone's monitoring, and the Federal Reserve. I would stress that the next key meeting is important, probably one of the most important meetings of the year because of what's going on with SVB and what's going on with inflation.
Okay, so let's talk about the services inflation here. That counts for what specifically?
That counts for medical services, financial services, pet services, anything leisure, hospitality. So it's a broad sector.
And this is a particularly large chunk of regular Americans' paycheck.
Especially in this day and age where the economy reopening and people are frequenting the establishments that offer these services. Yes, that counts for a large percentage of both their paycheck and the CPI as well.
So I guess my question has to be, Andrew, we see it at 6%, and 6% was the expected figure, roughly the expected figure. So does this mean that 6% inflation is now the new normal?
Well, not necessarily because, it's funny you mention that because I wrote an article on liberation.com, another one.
Andrew is a prolific writer on the site. Do please check it out.
I discussed how, because a lot of people are discussing, should the Federal Reserve just raise its target rate beyond 2% in order to exact confidence to financial markets? So, because that 2%, it's a pretty arbitrary figure. I mean, why 2%? So is 6% the new figure? Probably not. The Federal Reserve keeps stressing how it's going to do everything it can to bring down that inflation target back to its goal of 2%. So I don't think 6% is the new norm. However, I think that you're going to have a case similar to what happened in the late 80s and early 90s where you did see an easing of inflation, but then it went back up as the Federal Reserve kept easing monetary policy, and then it raised rates, cut rates again. So it was an ebb and flow of inflation that really hurt the U.S. economy at the time, and I think that's going to impact the stagflation environment of the U.S. today in the future.
So you've talked about how the way with which to sort of cut the rough edges off the inflation would be for the Fed to raise interest rates.
Well, yeah, that's the whole point. The whole point of the Federal Reserve raising interest rates is to kill demand. But when you're killing demand, of course, you have that recession. But I think the main factor in this inflation fight is the M2 money supply, as alluded to earlier. That's actually contracted for the only second time on record, and it's been on a steady decline since it reached its peak in April 2021. And so now the money supply is, I think, at what $20 trillion as opposed to $22 trillion. But still, I mean, that's money going away from the system. So when you have that inflation fight going on. And of course, when you have this bank crisis going on too, it inevitably weighs on economic growth. So the latest forecast is that from Mohammed El-Erian, he's a well-known economist. He's saying that probably for the future, as opposed to recession, you're going to have a stagflation environment of elevated inflation, slow economic growth, and perhaps higher unemployment. But it seems like this labor market is the one that never dies. It's just going to continue booming. So because in the last report, you didn't see any weakness at all. You still saw another 300,000 new jobs. So then that was the 10th straight report that beat market estimates. So I think I call this economy the nothing is what it seems economy, because you have no clue what's going on in this economic landscape. Some measures point to weakening, other point to strong growth, others point to high inflation, other point to there's some disinflation going on. So this is such a difficult economy to navigate for anybody, because most people have never, even Jerome Powell alluded to this, he's never seen an economy like this before.
I think the important thing to get a handle on is how it affects the lifeblood of America, which are your small businesses. Now, how does the inflationary costs and the interest rate battle, how does that impact the millions of small businesses that drive the country forward?
Well, okay, so there are a variety of answers to that question. I don't know.
Let's start with the simple one and work our way upwards.
So if you look at some of the PMIs, the Purchasing Manager Index, they give you a direction of where certain trends are heading. So one thing you're seeing in all these reports that there's a reacceleration in input costs and output costs. So that adds to inflation pressures. So with small businesses, not only do they have accelerated input costs, they also have still higher wages, which weighs on their expansion of their companies or operation of their companies. So that eats way more into their profit margins and balance sheets. When it comes to interest rates, when you have higher interest rates, that also adds to creates two environments. So first, you have higher debt servicing payments, so it costs more to maintain these debts, which a lot of small businesses rely on. The second one is accessing capital. So if you look at, there was a recent Federal Reserve Bank of New York survey of consumer expectations, and one of the results show that more people think it's going to be more difficult to access credit. So that's another issue for small businesses.
I could just interrupt very quickly. With small businesses, I'm sure most of our listeners are aware of this, but small businesses use credit options not because that they aren't fiscally viable, but because they have to deal with suppliers on different timescales to them, different billing supply timescale. So it might be they might have a credit note out for 3 months or something to one of their clients, and so that wouldn't appear on their balance book. So for them, they rely on credit to fill that gap until clients pay up, and I think it really cuts any profit margin they really have out of it when credit is more costly, doesn't it?
Yes, of course, that is true. And then to add to your point too, is that if these other companies are, especially the larger ones, if they're struggling in this environment, then of course it's going to also weigh on these small businesses and try to hurt their payment system or hurt their balance or the bottom line. And also one more thing too, if you look at some of the surveys of small business like the NFIB, a lot of them show that there's weakening going on in the broader economy. Their optimism has been pretty much stagnating for a few months now. So that's another thing to look at, because one thing that the Federal Reserve looks at is confidence in the broader economy. So if confidence is weakening, then that impacts how they respond to inflation, how they respond to economic growth.
And every time the market bell rings, an angel gets its wings or retires to Florida. Andrew Moran, thanks ever so much for joining us.
Thanks for having me.
We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
The Second Amendment once again under fire in the United States, this time courtesy of President Joe Biden's latest executive order. Now, to delve into precisely what the order details, we're joined by Liberty Nation's legal affairs editor, host of the excellent Uprising podcast, which I recommend everybody goes and listens to immediately after this show, Mr. Scott D. Cosenza, Esquire. Thanks for being here, Scott.
Cheers, Mark. Thank you so much.
So, we've seen Joe Biden's narrative since before becoming president, and his 2+ years in office has been the guy who's going to end gun violence in America. That was his campaign. He has had some joy with Congress passing, I guess, one of the most sweeping pieces of gun legislation in the last 30 years. Last year, in 2022, he did this. But he's just released a new executive order. What does it entail, Scott?
Well, I don't know that I want to give him the rhetorical win on that most sweeping in 30 years thing. That's sort of
okay. The only one. Well, it is by sheer virtue of it's the only actual gun legislation.
So this recent executive order has a number of facets to it. I think the overriding push is this is an opportunity for him to get public attention for his efforts. This was designed to make a splash, and we're giving him what he wants in a sense by talking about it. That seems to be the primary goal of it, based on how the announcement is structured. It talks a lot about what the administration has done, and strictly speaking, an executive order simply orders different parts of the executive machinery to do certain things. So, for instance, the Attorney General works for the President of the United States, and he, in parts of this executive order, he directs the Attorney General to produce a certain report or collaborate with certain other agencies to produce a report and make recommendations. Well, of course, that can just be done by picking up the phone and calling Merrick Garland or having one of his lackeys do it and just say, get this done. So what is the reason then for having this, a signing ceremony and a public announcement and a public executive order? Well, that is to drive conversation and narrative. And I think sort of to put administration officials on notice that what he's after is a Clintonian style attack against gun rights. And what I mean by that is when Bill Clinton was president of the United States, what we saw from his administration was something that we hadn't seen before, which was not just that gun control would be attacked legislatively through the suggestion of legislation or through executive action from the Justice Department for like who they prosecute and how they prosecute, that kind of stuff, Mark. But like every department of the government was basically told whatever you can do to clamp down on people who wish to keep and bear arms and express that right, you do. So, for instance, we have there's sort of historical action by the housing department to remove the right for people to keep and bear arms if they're in public housing. So Andrew Cuomo, for instance, was Secretary of Housing and Urban Development, and they went through this full court press to push against gun control, which resulted in kind of major policy developments in the gun control world. And one of the big companies almost collapsed, Smith & Wesson famously, because of their dealings with the Clinton administration and Cuomo. And I think that's what Biden's after here, generally speaking. And then there's
a whole of government approach to the presidential. And I think there's some more specific
aspects we can talk about. But yeah, but I think that was the two pushes. Is we're gonna get a lot of ink on this. We'll be seen as quote doing something, which Joe Biden said multiple times in his announcement, is that just do something.
Something big.
Yeah. If that's an acceptable reason to use the federal government to act.
I'm often entertained when the politicians, it's not so much that they wish to do something, but they rather wish to be seen to be doing something, whether they're actually doing anything or not. And I think there's a very important distinction there. And you rightly point out, Scott, that by doing executive action, which is really just instructional, I mean, there are teeth to some executive orders, but essentially he's not going to Congress and saying, let's make this the law of the land. He's doing it through his control apparatus of the federal agencies. So what are some of the factors that are being expressed as wishes through this executive order?
By the way, it's esse quam videri, which is to be rather than to seem. It was the North Carolina state motto too. I love it, by the way, and I think it's important. And I think what we're going to see, just to touch very briefly back on what I just said, is what's to come is something we're going to have to be on guard about. And what I mean by that is, what does the labor secretary have in store for us once they get the memo and the commandment from the Biden administration to go after guns and gun owners, right? What do all these, for lack of a better term, petty tyrants with their little fiefdoms, how are they going to use this directive from Biden, if at all, to infringe on gun rights and come after gun owners? So that's just something I think we should keep in mind. But then there are the specifics. There are no new laws passed, right? So what can we do? That's one of the things that was specifically mentioned was that basically if you are an FFL or federally licensed firearms dealer, you can expect that every single jot and tittle of your paperwork, licensure will be examined with a fine-tooth comb. And if you're outside the margin on any of it, whether or not it was a kind of you didn't put a period after a middle initial, or you put a middle initial instead of a middle name, for instance. Those are the kinds of things that we've seen in the past, again, referencing the Clinton administration, how they go after people.
Jump in on this about the FFLs, the firearms sellers. I believe that there's also some mention within the executive order that is wishy-washy enough that it could essentially classify a private seller as a firearms dealer.
So one of the things that the anti-gunners have always wanted to have is that they want to make no firearms transfer able to happen without the government as a partner. So, for instance, if a husband gives a wife a firearm or vice versa, or even a parent-child, there are states in this country where that kind of transaction has to be documented with a state transfer agency, basically the police or the government. But there are other states where it doesn't have to be the case. I live in Virginia, and in Virginia, family members can give, at the current state of the law is that immediate family members who are of age and otherwise not prohibited can give each other firearms.
And just in case anybody is wondering, that is Scott touting his Christmas wish list to Santa this year.
Yeah, to be sure. It's a lovely gift to present or to receive. I can tell you
Back
that.
to the plot, Scott. So
right.
yeah, the language is inarticulate enough that it could classify.
Let me just stop you there and say this. So what he does is he says to the Attorney General in the executive order, come up with a rubric for determining who is and who is not a dealer. Now, what this means for those of us who've seen more than a week's worth of Joe Biden's work is what that means is clamp down on people who are now sometimes selling firearms that we want to declare as a dealer. So for anyone who has more than a couple firearms, which many gun owners have a collection of firearms. If, for instance, you were going to sell the house and move to Florida, not necessarily just to escape the confiscatory taxes of red state or rather blue state, legislatures and flee to Florida, but just for as so many Americans do, especially from the northeastern states, as they age and want to go to a warmer place for retirement, they go to Florida. And let's say you're going to sell half the collection of firearms that you have or better because you're moving into a smaller spot. Well, you may have to be classified as a firearms dealer now because you want to sell more than like one gun a year or something like that. And that's the kind of thing I expect we'll see come out of this, is that Merrick Garland will produce a thing that says, this is what a gun dealer is. And then, Mark, here's where the hammer comes in, right? The hammer then is, just like with some of these other decisions out of the administration, including the previous administration and others, we see the executive rulemaking function. So Garland issues his report that says this is what a dealer is, and then without a change in the law, the ATF decides for itself, just like it did with bump stocks and just like it did with pistol braces, that it's going to reclassify who becomes a dealer required to be licensed. And so that would basically then prohibit most people from engaging in their own sale or transfer of a firearm and have to go through a storefront type operation.
And of course, if they fail to complete any proper paperwork based on this rule change, then that's an unintentional felony waiting to happen, right?
To go through and increasingly harder to find storefront operation if the Biden administration has its way to revoke as many licenses as they can, basically.
And was there also something in the executive order about the storage of firearms?
Well, he mentions the word storage twice in the order. The first is just to encourage Congress to. It's funny. He directs he directs Congress to pass this thing, and he encourages them, which includes safe storage, the Safer America plan, and then he also says that the secretaries of all the agencies shall expand existing federal campaigns and efforts to promote safe storage. So there's no action item there that I see that's coming down the pike easily to where that's going to be some kind of agency implementation. But look out for it, because when they get creative on these things, especially after a missive like this from the White House, that's the time to be on guard.
Remember, folks, there's no escape from a whole government approach. Scott DeCosenza, thanks ever so much for being here.
Thank you, Mark.
And that's about all we have time for on this week's edition of Liberty Nation Radio here on the Radio America Network. I'd like to thank you at home for taking the time to join us, and our guests Andrew Moran and Scott DeCosenza. My parting shot for this week comes courtesy of Henry Ford, who said, quote, "It's well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning," end quote. But perhaps he was a little bit wrong here. If our children were educated in how money and how bank systems work, they would at the very least be a lot less surprised when shenanigans came to light. But of course, a basic understanding of economics is not even on the radar of what public schools want to teach the next generation. And that, in itself, could be a greater threat to future prosperity. We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides. Entertaining, informative, and just plain fun. Watch Liberty Nation's The Conservative 5. Produced by conservatives for conservatives. C5's The Left Free Zone. Hosted by Liberty Nation's Lisa K. Donner. Joined by a raucous, irreverent panel of authors. Deconstructing leftist narratives. Debating the hot topics. And remembering to laugh. Join the official conservative safe
You only
space.
did that to piss Jeff off.
Liberty Nation's The Conservative 5.